Hello and welcome to this session in which we will dive into the cash auditing cycle. This is Professor Farhat. So what we will do in this session is explain why cash is important. Obviously, cash is king. And why is it important from an auditing perspective? Cash is susceptible to theft. It has a high inherent risk. Why? Because all $20 bill or $100 bill, they all look the same. So if you lose them, well, you cannot really trace them. So auditors also encounter cash in every audit cycle, obviously except inventory and warehousing, and we talked about this. And because we face the cash in every cycle, it's going to make our life a bit easier here because we're going to focusing on the thing that we did not cover in other cycles. But the key consideration for cash, as cash is an asset, would include existence. That's one of the important key consideration. Does the cash actually exist? Or is the company basically recording cash fictitiously, reporting cash that they don't have? Completeness is important. Did we reported all the cash? Is it accurate? And is it reported in the prior period? So those are the key consideration. Now we want to have a detailed tie-in, make sure it's tying to the trial balance and all that. But I'm showing you the most important key audit objective, which we will see later. Also, from a business risk, we want to make sure that the company maintain an appropriate cash management policy. We want to take a look at how do they handle their cash, because cash is critical. It's high risk area. That's why we have to make sure they have a company policy. Also, when it comes to materiality, performance materiality, the performance materiality for cash is low. It means we don't tolerate any mistakes. Why? Because it's important. That's one. And it's ease of auditing the cash balance. We can count the cash exactly how much we have. So we cannot say we should tolerate $5,000 errors or $10,000 errors. Performance materiality is set very low. Also, inherent risk, as I told you, is high because cash can be easily stolen if we have no proper control. But we're going to be focusing first on control risk, because control risk determine how we handle the audit. Now, although we're going to be looking at control risk or examining the internal control for the company over cash handling, we're going to be focusing on something we call the bank reconciliation. Why we're going to focus on the bank reconciliation, I'm going to repeat this maybe one more time and maybe another time again, is because we looked at the control of cash and other cycles. So as we covered the revenue cycle, we looked at the control for cash. As we covered the payment cycle, so on and so forth. The only thing we did not cover is the bank reconciliation. So in this session, we're going to revisit the bank reconciliation. We're going to be introducing two new documents, which is the confirmation, bank confirmation, and the cutoff statement. So technically, there's going to be three documents that we will be using in this session to audit cash. Bank reconciliation is one. What do I assume here? You know how to prepare a bank reconciliation. Why? Because you are an audit student. Why? Because you took intermediate accounting before. If not, if you don't remember and you really want to know how to prepare a bank reconciliation from scratch, go to my website, intermediate accounting chapter for the cash, and look at it, or financial accounting if you want to go a little bit lower. Then we're going to use the bank confirmation plus the bank cutoff statement to make sure we meet our key audit objectives. But first, I'll explain those documents. I will show you the end product, and I will show you the actual documents. This way, everything fits. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Our audit course is best for online students and students who are struggling in their audit courses. We cover the essentials from audit reports, internal control, ethics, evidence, sampling, planning and materiality, assurance and non-assurance services, and of course, the accounting cycles. Our comprehensive course includes lectures, multiple choice, true-false questions. Go ahead and start your free trial today. We are here to help. Your success starts here.
As always, we always start with the internal control, since we talked about what's cash in the prior session. Internal control, as I said, is covered in other sections. So control over cash transaction deals specifically with the recording of cash receipts and cash disbursement. Well, generally, we discussed those in previous audit cycle, except in the inventory and the warehousing cycle, we don't have it we don't have it because we don't have cash. And I showed you that in the inventory and warehousing cycle. So in this session, we will focus on this independent bank reconciliation. Again, what's bank reconciliation is you're looking at two things and making sure everything in A is in B and everything in B is in A. We're reconciling. That's what a reconciliation is. Reconciliation is an important concept in, you guessed it, in accounting. So bank reconciliation involves matching the company's cash records, which is the general ledger, with the bank statement to identify any discrepancies, and you should be able to account for these discrepancies. There are going to be differences between what's on the bank statement and what's in the cash ledger. We call those timing differences. We recorded it in the bank, or the bank recorded something, we have not recorded it yet, or we recorded it something, the bank is not aware of it. But we're aware of everything, therefore we reconcile, we'll account for everything. And that's basically what the bank reconciliation is. So the effectiveness of this control significantly improved when an experienced employee independently reviews the bank reconciliation shortly after it's completed. So you want this process to be done by someone who's independent of cash receipts, cash disbursements, cash deposit, and you want somebody also independent looking at the cash reconciliation. Now, for larger companies, bank reconciliation are performed more frequently than monthly. For example, it could be weekly or even daily to maintain tighter control over cash flows. I can tell you from my personal experience, when I was in practice, most companies that we worked for, most companies wanted monthly, some wanted quarterly. But at some point I work in an institution, I'm not going to name, I'm not going to tell you what it is, but in an institution where we perform cash daily reconciliation. It's a government institution. They wanted to do it that way because there was a reason for that. This division, what they did is they handled what we called cash for others, agency cash, and they wanted to make sure every payment that we received is accounted for, because it's not really for the government institution. It was payment made and we were the agent of that other government institution. So the managers performed daily reconciliation. What does that mean? It means whatever we received that day, the following day, the manager made sure that money that we received made it to the bank. So they would look at what we received the prior day. Somebody made the deposit. The following day would look in the bank account and make sure it matches. So it's daily reconciliation. Why? Because it's important. So when reconciliation are delayed or performed by people who handle cash directly, control weakens. So we want to make sure we have the proper internal control. And that's a red flag for auditors when this is happening. Because if someone can perform the bank reconciliation and is responsible also for cash receipts and cash disbursement and making deposits and writing checks, that's not a good thing. You want these to be individual, separate from preparing the bank reconciliation. Also, in the real world, a lot of companies, they use software called QuickBooks or SAP or some sort of proprietary software, and the software itself perform the bank reconciliation for you as long as you are making all the payments through the system. Every time you receive money, it's recorded in the system. So what happens is if you record everything into the computer system and your bank statement can be uploaded or connected, or your system connected to your bank account, the system automatically will match everything. So it could be very easy in case everything is being done through a system. QuickBooks does a good job with the bank reconciliation as long as everything is recorded in QuickBooks. So you're not writing checks outside QuickBooks and not recording the transaction. Otherwise, it's an easy process once you have it up and running. So what gets checked in a proper reconciliation? So what are you looking for? You're looking at canceled checks. Okay, canceled checks means what? You wrote the check and now it's back to you. It's cleared. Whoever you wrote the check to received it. Now you could receive the actual canceled checks, but these days you don't receive the actual check anymore. It's a copy of it. You would compare the amounts, payee dates. You want to make sure that who you paid, the amount, and the dates are properly recorded. And sometimes you want to go as further as signature to confirm legitimacy. Now, do you do this for every bank reconciliation? No way. Some bank reconciliation would involve like 500 or 600 canceled checks or payments. You don't do that. But the proper reconciliation is making sure you're checking everything. But that's what we need to do if you want to go any further. Deposits. Make sure each matched recorded cash receipts for the proper customer date and amount. So you made a cash deposit, you gave the credit the proper credit, the date, and the amount. Now, do you do this? No, but if you can do this if you want to. When you make a deposit, you bunch, like for example, 30 customers together and you make deposit all at once. But as you are recording the deposits, you do this matching. But this is technically what you could do with the bank reconciliation. You want to take a look at numerical sequence of checks to spot any missing, duplicate, or out of sequence check numbers. That's something you do during a bank reconciliation. And most software, they will kind of point this out for you. This check is missing. You have a duplicate check numbers. And obviously, the most important thing in a bank reconciliation is you investigate reason for any mismatch between books and statement. Why? Because everything on the books should be on the bank statement. Everything on the bank statement should make it to the book. So each must fit the business context and have proper backup. So everything has a proper backup if need be. So that's the bank reconciliation. Again, the assumption here, you know how to prepare a bank reconciliation. You are familiar with it. In addition to the bank reconciliation, as part of auditing cash is we're going to have a bank confirmation. When I say a bank confirmation, you should be familiar with the term confirmation. Why? Because we have an account receivable confirmation. Remember, during the revenue cycle, we sent confirmation to customers to confirm how much they owe us. Account receivable confirmation. Same concept here. Just like you were confirming receivable, if they really exist, you contact the customer. What we do now is we're going to send the bank confirmation to the bank to tell us if they have an account and what's the balance for that account. So it's a formal request sent to the bank to confirm all account balances, loans, and collateral as of year end. And we're going to see one soon. You're going to see what a bank confirmation looks like. Now, in modern audit, and as I was leaving the practice, now you could use secure website or portals. I don't remember the website. It's confirmation.com or something to that effect. US confirmation, USA confirmation. And you can go in there and create an account. I used to have an account. Then you would submit those bank confirmation, which speed up the process and reduce the risk of tampering, because the system, basically sometimes the system automatically communicate with the banking system. So there's no person involved to make a mistake, and no one can make a change because the computer doesn't lie. Whatever it has, it's going to tell you. Now again, with all of this, whether you are sending a bank confirmation physically, a request physically, or sending it through the website portal, you need the customer approval. In other words, on the form, you have the customer signature, and on the bank, if you're using a website or a portal, an online portal, or any form of digital confirmation, you will need the customer approval. Sometimes you do get a bank confirmation even for interim period if necessary, if the amount is material or you think it's necessary. Now, what happens if the bank does not respond? Well, usually electronically they respond, but let's assume you send them a physical request and they did not respond. You'll have to send a second request, just like an AR, you send a second request. Or you want to ask the client to contact the bank. Just if the bank is not responding, you just ask the client, look, contact your bank, we send them this bank, because if we contact the bank, say that's not your account. But if the customer called them, they will answer. And follow up directly by phone or digital means, whatever is needed. Now, what you want to do is review any return confirmation for accuracy. So when they get it back to you, you'd say, okay, they're going to give you a number, a dollar amount. Record this for accuracy. Remember, we have to, as part of the key audit objective is accuracy. Look for completeness, that they list everything that we asked them to list. Consistency, does it match with the client record? So this is what we look for. And we have to investigate and explain any mismatch. And that's the whole purpose of bank reconciliation audit is once we have this bank confirmation, we could look at discrepancies and we need to investigate. Now, when resolving old inactive account, if there are many, auditors may skip some unless issues appear. So the bank might have old accounts for that customer. You may skip over that if they are old and closed, unless there is an issue. You think fraud going on, or they did not report all the accounts by mistake, or an account still open, then you will investigate further. So what information gets confirmed? So what's in the bank confirmation? Well, the cash balance in all accounts related to the client. if there's any loan, confirmation of loans, line of credit or guarantees, evidence of inactive account or dormant funds. Because let's assume a person at the bank received this, and usually banks will have a whole department for that type of thing because they do this all the time. So they'll have a department for bank confirmation. Once they receive the request, they look up the account and they fill out the form. Again, now it's electronic. They would look up all the accounts and they would list them there. Now, bank rarely confirm unrealizable value or how cash should be classified on the balance sheet. They should not. That's not their job. So if there's any foreign currency, they're not going to tell you what should be the value or how you should classify the balance sheet. So know what the bank confirmation doesn't get you. Since those don't involve since those items don't involve rights to cash, because they cannot tell you this. They don't know how to classify this cash, whether it's restricted or not, and what's the value of that cash if it's in foreign currency. They just give you the number and it's your job. In addition to the bank confirmation, we have to be familiar with something called bank cutoff statement. So what's a bank cutoff statement? Well, it's not really a complete bank statement. It's a short period, for example, 7 to 20 days, a partial bank statement following year end. So basically, you can go to the bank and tell them, could you print for me the last 20 days of transaction? That's a partial or a cutoff statement. For example, why do we call it cutoff statement? So if you are looking at December 31st year end, you would say, I want the up to January 20th, all the transaction that happened after December 31st till January 20th. Why? Because you want to confirm any deposit in transit. If on December 31st on the bank reconciliation you have a deposit in transit, it should appear by January 20th. If you have any outstanding checks, it should appear by January 20th. So you want to make sure that the deposit in transit that they're claiming, the checks outstanding that they are recording, are actually legit, real. How? Just give me 20 days after year end, after the period, and if those appear, then they are legitimate. But what else are you looking for? You are looking for a check here that cleared, that was written before December 31st, and it was not outstanding. That's what you're looking for really too. So why did the check clear, but it's not recorded as an outstanding as of December 31st? So the bank cutoff statement is basically a complementary or a supplementary document to your bank statement. The goal is to get a snapshot from the bank that include all transactions from the balance sheet date plus those clearing after. So the cutoff statement must come also directly from the bank, whether by mail, email, secure portal, or you can go to the bank and ask them if they have the permission from the customer to print the last 20 days of transaction. The cutoff statement basically is a safety net, catching transactions that don't belong in the closing period. As I mentioned, you want to look for transactions that appear after year end. It's recorded here, but not recorded in period 1, but it's appearing in period 2, but it belongs to period 1. Again, a prime example is a check that's cleared in period 2 in January, but it's not outstanding as of December 31st. So if items show up after the cutoff date, auditor dig deeper to see if any recording games were played. This is what you're looking for. This step protects the integrity of the cash balance and guards against statement manipulation. So how does the auditor use the cutoff statement? We're going to see it in action. Well, they inspect all canceled checks, deposit, credit memo, and debit memo within the cutoff period. They would look at all of those. Say, did any of these should be appearing in the prior period? Any checks, any deposits, any credit memo. The bank gave us something, it should be in the prior period, but it's recorded in this period. Any debit memo. Debit is mean when the bank takes money away from your account. Credit is when they give you money. It's the opposite of debits and credits for accounting. Well, it's a funny thing, but the banking language is the opposite of accounting. Credit is they gave you money. Debit is credit gave you money. Debit, they took away money from you, which is an accounting. Debit is increased cash, credit reduce cash in accounting. So we verified that no transaction have been slipped in or out to manipulate the balance sheet numbers. That's the whole purpose. So when auditing the cutoff, auditor look for the cutoff errors, timing differences, and possible fraud detection signals. And we're going to talk about fraud in the next session, because looking for fraud in cash should warrant its own lecture, such as check posted just before the year end but clearing much later. As I told you, outstanding checks that we said we did not see. Now the next thing we are going to look at is an actual bank reconciliation, a completed one that's audited, but we need to take a look at the various pieces of it. So the assumption here is you have an idea what a bank reconciliation is. And this is what a bank reconciliation is. But you see there are tick marks and tick legends here that you are not familiar with. So this is a bank reconciliation as of December 31st, 2023. This is called Schedule A2, prepared by the client, the date that was prepared, approved by someone, RR, and the date that they approved the bank reconciliation. And this is for account number 105. We're going to start with the balance per bank, and this is the balance per book. So those are the two sides. So the balance per bank statement as of December 31st, 2023 is $87,942. Hold on a second. Where did that number came from? You want to check? Look at B1. What's B1? It's the bank confirmation. So how do we know if this number is legitimate or not? We requested a bank confirmation at the bank from December 31st, 2023. Remember we talked about the bank confirmation? And notice here it confirmed that this account is $87,940. So notice this is a $87,940. So this is an external document. This is what a bank confirmation would look like. The customer is Sunrise Manufacturing. The name of the financial institution is Coastal Bank, and basically we send them information to give us information about the account number 105, about any loan account information. So they look like they have a line of credit and an equipment loan for $80,000 and $120, the interest rate on these loans. The customer authorized signature is Lauren. The person that provided this information, financial institution authorized signature, James, from the senior, it's a senior bank officer. Exception or comments, none. This is all what they have, a bank account and 2 loans. Please return directly to the CPA. And this is Schedule A2/1. So this is basically, we're going to call this B2 for our purposes. So this is basically what we're saying is the reference, go to B1 file and you're going to see that bank confirmation. Then we have deposit in transit. We have 1, 2 deposit in transit, 9,500, 6,200. Well, that's what the customer is claiming. We have a check tick mark, and what does that mean? It means verified against bank deposit, log, and cutoff statement. So what we did is we looked at bank deposit and cutoff statement, and those 2 deposit in transit are legit. The total deposits, basically we sum here. We sum, and if we sum, we just make a note. For example, we sum them, and we say it's showing that we summed them, then subtotal. Then we have outstanding checks, check number 1542, check number 1547, 1549, 1550 for all the balances. Again, we have like an X legend, and guess what? We also traced the December disbursement journal, and most likely we looked at the cutoff statement too to make sure that they cleared. But the December journal, if they're showing them in the journal, they should be legitimate. Nevertheless, we want to make sure they're not recording checks to record the transaction expenses, cost. So what we do is we also look at the cutoff statement to make sure we check them. Again, they're checked. We total everything, and when we total, we foot everything. When we have some sort of a tick that we foot them. Then the adjusted balance 89,755, and we trace this to the trial balance, and this is detailed tie-in. Trial balance, it means we agreed with the year-end trial balance. Now on the balance per books, 92,050. This is from A1. This is our book per balance. Then we have $75 from the bank. If we look at A2, we're going to see a bank statement, and there's a $75 check from the work paper. Then customer check return, non-sufficient fund, 2,175. How do we know this? Look at A3. Total adjustment, 2,250. We foot them. We take $92,005 minus 75 minus 2175, which is in total minus 2250. Again, when we foot, we have some sort of a tick mark legend to kind of indicate that we did the computation, and the total, the adjusted balance, again, we foot it 89,755, 89,755. And this is what we did, is we audited the cash balance. We audited the cash balance. What's the source document? What did we use? We used the bank confirmation. We used the cash disbursement journal for the outstanding checks. We used the cash deposit the cash receipt journal for the deposit. We looked at the bank statement. We looked at a cutoff statement. So you need to know what source document did we use. And this is basically a bank confirmation. So let's summarize real quick now, put it in the audit language. What did we do? Well, detailed tie-in. That's one of the audit procedures and audit objective. Detailed tie-in. What does that mean? Check the mathematical accuracy of reconciliation, match balances with the general ledger and trial balance. And I did this. Remember I told you I'm footing everything. I'm footing everything and tying it to the trial balance. This is what we mean by detailed tie-in. That's important. But what's more important is the existence. Did the cash actually exist? Yes. How was I assured that the cash actually exists? That the customer gave me a bank statement. They might have, but I did not agree to that. I did not accept that. I asked for an external confirmation. So remember that bank confirmation confirmed the cash balance directly with the bank. And this is what I'm talking about. This statement here. This is what gave me assurance that the $87,940 is legitimate. Now, can the customer have someone at the bank working for them and give me fictitious? Yeah, that's going above and beyond, right? Did it happen before? Possible, but in the absence of that, we assume that the bank is an independent third party and the bank will have their own control. So even if you know someone at the bank, most likely not one or two person will confirm that. So it gets harder and harder. So I have a bank confirmation, I'm good. Completeness, ensure all cash transactions are recorded. This is the cutoff statement will do that I accounted for everything. Accuracy, rechecked reconciliation calculation and verify transaction. I recheck everything, the figures, and this is going to help with accuracy. So existence, completeness, and accuracy are important. I'm not saying detailed tie-in is not, but if the cash is there, it actually exists, it's complete, and it's accurate. If you did not do the tie-in, it's not a big deal. It's correct, but you did not do the tie-in. It doesn't mean it's not important, but that's important. Cutoff is important as well, making sure you recorded all the deposit in the proper period and all the withdrawals in the proper period as well. Let's take a look at common cash risks and how company address them. Typical risks are poor cutoff procedures, reporting cash when it doesn't actually belong in that period, unauthorized transaction or changes to the bank statement. That's a risk. We have to look into if we suspect. Lack of backup documentation. If we see something, there should be a source document for everything. Delayed or missing reconciliation. If the company don't prepare those reconciliation on time, it's a problem. Incomplete reconciliation or tampered bank statement, that's also a red flag. Again, but we don't want to rely on their bank statement. We would rely on the bank confirmation plus the cutoff from the bank. If there's no independent review before closing the books, no one is really looking at the bank reconciliation, independently verifying it. And every time the auditors spot these gaps, they need to expand their testing and challenge management ability to safeguard cash, if there's any of those. So mitigation strategies from the company, what you should recommend: segregation cash duties, different people handling receipts, record and reconciliation, basically segregation of duties. Restrict access to bank statement and digital record, so they're not easily tampered with or manipulated. Insist on direct delivery of sensitive document to the audit team. We don't want any person receiving the bank reconciliation or the bank confirmation. We want to receive it directly. Now, if we suspect any of those, then we suspect fraud. And when it comes to fraud, auditing cash for fraud, that it's its own separate recording we would look at next. We're suspecting fraud, or we want to go a little bit further. The internal control are weak. Then we would look at different procedures. For now, let's take a look at this multiple choice questions from farhatlectures.com. Which of the following is least important balance sheet related audit objective in cash? They're all important, but which one is the least? Let's start with the most important. What would you think is the most important? Cash is asset. Always the most important audit objective for any asset is existence. Does it really exist? But we're not asked about the most important. That would have been easy. It would have been existence. So we can take B out. How about accuracy? Do we need to report the right numbers? I would say yes. That would not be the least important. Completeness. Did we reported everything, all the cash in or the cash out? That's important to completeness. How about detailed tie-in? Is that important? Yes, it's important, but it's not as important as the other three. If the other three are correct, the detailed tie-in should come in as an easy step. Just looking, making sure that the work paper matches the trial balance. I mean, I'm not saying it's not as important, but if the cash doesn't exist, that's more important, right? So I would say the detail time is the least important, but important. Let me double underline important. What should you do now? Those are the tricky audit questions. That's why audit is tricky, because they're all important, but rank them. What should you do now? You want to go to farhatlectures.com, where you have additional lectures, resources, multiple choice, true, false. That will help you, whether you are an accounting student, CPA exam candidate, or just studying for your professional certification, or trying to improve your professional standard. Invest in yourself. Good luck, study hard, and of course, stay safe.